Hello everyone, welcome back to this channel. So we will be doing the remaining part of demand today. That is, we covered till the law of demand in the last video, and we saw that there is an inverse relationship between price and quantity demanded. That is, when price increase, quantity demanded will fall. And considering only these two aspects in the model right now, we have that ceteris paribus prevails in the law of demand. That is, keeping other things constant. Now, what are these other things that we talked about earlier? Let's get a quick recap about these things. So these things that are kept constant can include tastes and preferences of a person. You can also say income of a person. You can also say the prices of the related goods. Next we can have is the taxes, or you can say the disposable income. Disposable income is the income that is left with the people after they pay for taxes to the government. And there are n number of items more. So all these things are kept constant while we talk about the law of demand. Now, moving forward with this demand concept, we have the movement or the movement of the demand curve, and there we have is two main things that are extension and contraction. So considering this demand curve on the left hand side of the screen, this is just one demand curve. You can see DD is the only demand curve that we have on the in the graph. Now we'll consider initial prices we'll consider as P, and initial quantity here will be Q. Now we'll consider Q, P and Q as the initial price and quantity. Now suppose we'll figure out what is extension and what is contraction and how actually do we move on the demand curve. Now what does movement mean? Movement means that when there is you can say change in the point of the demand curve, or change in the point on only one demand curve, that is DD here. So considering the initial price P and initial quantity as Q, price on the y-axis, quantity demanded on the x-axis, if suppose the prices increase from P to P1, P2, sorry, P2, and the equilibrium, or you can say the point reached is point C, you can always say that the quantity demanded has decreased from Q to Q2. That means when price increased from P to P2, quantity demanded decreased from Q to Q2. So what is the shift, or maybe what is the movement? It is the movement from A to C. This is called contraction in demand. Why is it called contraction? You will just figure out that there is a decrease in the quantity demanded of a commodity. So we'll figure this out as contraction. Now, considering the opposite case, suppose the prices, that is initial price reduced from P to P1, that is prices reduced from P to P1. The corresponding quantity will obviously increase from Q to Q1, that is Q increased from Q to Q1. So we can see that there is a movement from point A to point B. This is called extension. Now, why is this called extension? Because there is an increase in the quantity demanded. So very simple, that is, if there is an increase, if quantity increases, it's called extension. If quantity decreases, it's called contraction. So this is the only point of significance that we come across when we talk about movement of the demand curve. Now, similar to this concept of movement, we have the shift in the demand curve. So considering the shift, there's a difference between the terms, that is literal meaning of the terms movement and shift. Movement means when there is only one demand curve and we move from one point to other regarding the price increase or decrease and the corresponding quantity increase or decrease. Now, considering shift, shift means when we totally shift or increase the demand curve and decrease the demand curve appropriately because of many reasons. Now, consider one thing. that movement of the demand curve happens just because of the price change. So if there is any change in the prices, the price increase or price decrease, the corresponding quantity increase, decrease will lead to either contraction or extension. Now, regarding shift, these are non-price determinants that affect the demand curve, and we will be talking about ceteris paribus condition here. Now, we talked about a condition that is keeping other things constant earlier when we were on the law of demand. Now, considering non-price determinants, we will not consider price here at all. We will consider other factors or other determinants that affect the demand curve, and that leads to increase or decrease in the demand curve. Now, considering increase in the demand curve, when there is increase in the demand curve, there might be certain factors that lead to increase in the demand curve, and what is the main consequence of this increase in the demand curve? The demand curve will shift rightwards or upwards, maybe from D1 to D2. This depicts an increase in the demand of chocolate. And considering a decrease in the demand curve, the demand curve will reduce from D1 to D2. This shows a decrease in the demand curve, or leftward or downwards maybe. So this is called increase and decrease in the demand curve. Now, there are few factors that are these non-price determinants that cater to the either increase or decrease in the demand curve. Now, any one determinant can also lead to increase, can also lead to decrease. Now, we'll see how. So, considering the reasons for the shift in the demand curve, these reasons only lead to a shift in the demand curve. Why? Because these reasons are totally non-price determinants. Now, you can see that in all these reasons listed here, you will not find anywhere the price of the good that we are talking about. Suppose we are talking about shoes here, so we will not be talking anything about the price of the shoes under these reasons. We can look forward to price of some other related good or some complementary good, but not the price of the shoes primarily. Now, coming on to the first one, that is income of the consumer. Income is very important, and we have reference of normal and inferior goods. Now, considering what are normal goods and what are inferior goods. Normal goods. So normal goods are those goods which increase, for which the demand increases when the income of a person increases. So when income increases, the demand of these normal goods also increase. Considering what are inferior goods? Inferior goods are those goods that when income of a person increases, the demand for inferior goods fall. So now, as the name suggests, inferior, obviously low quality or backward goods that the person might not use when the income increases. Because if the income increases, he will increase the purchasing power. He will have an increase in the purchasing power that will lead to increase in the demand for normal goods and not for inferior goods. So this is the main difference between normal and inferior goods. Now, coming back to what the topic we are on, that is shift in the demand curve. Considering income of the consumer. Now, if the income increases, obviously the demand will increase. If we consider normal good here, if income of a person increases, the demand for the normal good will increase and the demand curve will shift rightward. Now, if it is the case that the good we are talking about is inferior, obviously the demand will fall and this will happen. That is a decrease in the demand and a leftward shift in the demand curve. Next is we have taxes paid by the consumer. So taxes are the amount that the government pays to that the people pay to the government for, suppose, income tax is a type of tax. So these are the types of taxes, or maybe you can say say GST, etc. These are the types of taxes that the people pay to the government. So income tax is a direct tax, GST is an indirect tax. There's a difference. But considering taxes as a whole, if we talk about taxes, if the taxes increase, suppose if the taxes increase, then obviously the purchasing power of the people will fall. Why will it fall? Because people will have to pay more amount of the income to the government, and the purchasing power will fall because they will be left with lesser amount. If the purchasing power falls, obviously consumption will also fall. Or you can, consumption being synonymous to demand, that means demand will also fall. Now we have is a reference of disposable income. Disposable income, or you can say the personal disposable income, anything, is equals to the income that you get from a job or from working minus the taxes that are paid to the government. So income minus taxes is the disposable income. Now, if we say that taxes have increased, that means your personal disposable income will fall. Why? Because you will suppose your income is 50,000 and your taxes earlier were 25,000. Hypothetical example, this will lead to 25,000 your disposable income. Now the taxes have increased. Suppose they became 50,000 minus 30,000. Now your disposable income is 20,000 only. So this is again your, that is 25,000 decrease in the disposable income due to increase in the taxes. So if the taxes increases, the disposable income will fall. When disposable income falls, this will lead to low purchasing power again, and this will further lead to decrease in demand. If the demand decreases, the demand curve will shift leftwards, and there will be a decrease in the quantity demanded. Now you might have noticed one thing earlier, that it does not include price. That is, these are non-price determinants. That means the prices are equal. That is, prices remain stable. The only thing that is changing is the quantity demanded. Now, if we consider this hypothetical example here, these are the prices, suppose, and this is quantity 1, quantity 2. Because there's an increase in the demand curve, or you can say demand, the quantity demanded will also increase. Now, one thing here is to remember is that there is a difference between demand and quantity demanded. Demand is will include all the three things that we started with, that is need or want of a person, plus willingness to pay, plus money, or you can say required availability of resources. And quantity demanded is nothing but the number of goods or services demanded. So these are the these are two different things. That is, there's a distinction between demand and quantity demanded. So in this case, the demand is increasing and the quantity demanded is also increasing, but the price remains constant. Why does the price remains constant? Because shift in the demand curve is catering to only the non-price determinants and does not take into account the price factor. Now, considering the decrease in the demand curve, likewise, we can say that there will be a decrease in the quantity demanded due to the changes in the different factors that we were talking about earlier. So this is the difference between demand and quantity demand. Okay, let's come back to the reasons. So considering taxes, when the taxes increase, the demand will fall. When the taxes decrease, the demand will rise. Now the next is price of substitute goods. Now when we were talking about what are substitute goods, we talked about the main classic examples of substitute goods, that were tea and coffee. So if we consider the market for tea and coffee only, let's take a primary market to be market for tea. Okay, market for tea. This is a primary market. So what is the substitute good here? We have coffee. Suppose the price of coffee rises. What will be the impact on the market for tea? The market for tea will witness an increase in the quantity demanded of tea. Why? Because with the increase in the price of coffee, the people will decrease the demand for coffee, and will shift on to the market for tea. That is, they will increase the quantity demanded of tea. Now, since we are talking about the market for tea as the primary market, the quantity demanded will increase. That is, the demand of for tea will increase, and there will be a rightward shift in the demand curve, leading to this graph. So this is the scenario for substitute goods. Now we can take any other substitute goods, whatever we like. We can take purple shirts, we can take red shirts. These all are substitute goods. Next is price of complements, that is joint demand. Okay, price of complements. Suppose we'll take petrol, car and petrol. These two are complementary goods. So car here, suppose we have a market for car. We are talking about the main market as market for car. Now considering petrol, suppose the petrol prices increase. What will happen to the market for car? The quantity demanded of car will fall. Why will it fall? Because the people will see that the prices of petrol have increased. They will have no benefit of purchasing a car. That's why the quantity demanded for car will fall. That means the demand for car will fall. This will lead to a leftward shift in the demand curve. Now, in the opposite case, suppose the price of petrol falls. This will obviously lead to the demand for cars to rise. Why? Because the people will be getting less, will be paying less to pay for petrol, and they can buy petrol at cheaper rates for the car they own. So this is the changes in the demand curve when we consider complementary goods. Now, why is it called joint demand? Because obviously car and petrol are used jointly. They cannot be used single-handedly. Next here is consumers' tastes and preferences. Consumers' tastes and preferences here means nothing but the, you can say, changing fashion or a more liking towards a particular good. So consumers' tastes and preferences, suppose if you are attracted towards another TV set, or maybe another pair of shoes, or maybe another cloth or t-shirt, shirt, or maybe jeans, etc., can lead to an increase in the demand primarily. Now, if you do not like some of the goods, or you can say taste, you do not have a taste in different types of clothing or maybe shoes, etc., then this will lead to a fall in the demand for that particular good. Next we have is future expectations. Now, future expectations are very important in this context. Now, let me explain you how do they work. We'll talk about two periods, current period and future period. Now, since we are present in the current period, we will be talking about current period market only. That means whatever changes are there witnessed in the current period, you will be shifting your demand curve accordingly. Now, future expectations means there are changes in the future. What is their impact in the current period? Now, suppose I'll take an example of TV. Let's take an example that you have selected a TV that is worth rupees 40,000 today, right now, and you are expecting, or you get an you are, or the company is expecting, or you get the information through an insider that the TV that you've selected will be costing rupees 20,000 after a month, 1 month. So this is a future period. So when we consider, that is, we'll write here rupees 20,000, and here it will be rupees 40,000. So since you are present in the current period, obviously, if you know that in the future period, you will be getting the same TV for rupees 20,000, no rational human being will purchase the TV today. So 40,000 on this price, you will reduce your demand for TV. And in the future period, the demand for TV will rise. So this is one of the examples of future and current period. That is, if you are expecting a positive point in future, you will cater to same analysis in today's period, irrespective of the different factors that you have. Might be you might stop using a TV, or might be a case that some people look for TV when their existing TV is quite old. So there might be other factors affecting this. But if there is a so much decline in the prices in the future period, any rational human being will stop, wait for a month, and then purchase the TV properly. So these are called future expectations. Now this can be opposite as well. Suppose the TV costs today 40,000, and it is expected that the TV will be costing 60,000 after a month. This will lead to the demand of TV to rise in the current period and demand of TV to fall in the future period. Since we stick on to the current period, we will be drawing the demand curves decrease in the current period only, and nothing in the future period until and unless it is asked. Next here is advertisement of the product. So regarding advertisement, obviously it is beneficial for any person to advertise not person, for any firm to actually to advertise the product so that they will attract customers. In case of advertisements, obviously customers will be attracted towards that particular good and they will buy that particular good. So for any firm to attract customers, they increase advertisement. That will lead to increase in the demand for that particular good, and the demand will shift rightwards. Next here is population, number of consumers. If the population in a region, area, or maybe the country increases, or number of consumers increases for a particular good, obviously the demand will shift rightwards and there will be an increase in the demand. And in case of increase in the death rate, or maybe increase in improper health conditions, that leads to improper health problems to the human beings, that will lead to a decrease in the demand curve, a fall in the demand curve, that will shift the demand curve leftwards. And the last thing we have is peak and off-peak demand. So let's see what is peak and off-peak demand. Okay, so peak demand and off-peak demand, as the name suggests. Suppose peak demand. Peak demand refers to the demand that is the peak demand is the demand for those goods that are seasonal generally. Now, what do you mean by seasonal? Suppose if I talk about rainy season, the demand for umbrellas and or you can say raincoats increase in the rainy season. This is peak demand. Why peak demand? Because no other season. There are very few people that use umbrella in sunny season, but generally umbrellas are meant to protect you from rain. So this is a peak demand product. That is, in the rainy season, people will be demanding umbrellas and raincoats only once a year when there is rainy season in their area or region. Now, considering peak demand effects on the demand curve. Obviously, if there is rainy season in the country, the people will be demanding umbrellas and raincoats. That means demand for umbrellas/raincoats will rise. This will lead to a rightward shift in the demand curve. That is the first one, increase in the demand curve. Now, considering on the other hand, if it's a sunny season, or you can say not sunny, maybe summer season, or you can say winter season, you will not be demanding umbrellas and raincoats. So the demand for umbrellas/raincoats will fall, and the demand curve will shift leftwards. Now till here, this was peak season, peak demand. For off-peak demand, we'll consider sunny and winter season, or summer and winter season, where we can see that the demand will fall for that particular good. So there will be a leftward shift in the demand curve. Now, the last thing here is diseases. Diseases, if we talk about COVID primarily. So the necessary goods, demand for necessary goods increased, demand for luxury goods decreased, demand for, you can say any kind of brands or you can say clothes or anything that was not necessary did decrease. That means there was a fall in the demand. Only for necessary goods, there was a rise in the demand. So here we see that these are the reasons that shift the demand curve either rightwards or leftwards. One reason, each individual reason can have both effects on the demand curve. That is, each reason it can either shift the demand curve rightwards or can shift the demand curve leftwards. One thing to note here is that all these are non-price determinants. They will not use prices at all. So these are the reasons of the shift and the things that we were talking about, ceteris paribus, keeping other things constant. These are those things that are kept constant. All these 8-9 points are those things that are kept constant while we talk about the law of demand. That is when price increase. That is when price increase, quantity demanded falls. So I hope this is clear to everyone. If you have any questions, please comment and I'll answer them. Thank you.